Joining Alessio and me from Miami is Kathryn Rooney Vera, Baltic Head of Research and Strategy. Kathryn, are you bullying the Fed? Like, is this what you've done to the market?
Alex, you're totally right. I and everyone else, we're all bullying the Fed. The Fed is going to cut rates because the market so demands. Anytime the market is pricing in more than 60% probability of a Fed cut, the Fed has not failed to deliver. So certainly this is a Fed, Alex, that wants to extend and expand this economic expansion, keep the rally going in the markets. They do not want to repeat what happened in December of last year when we all know what happened, almost 20% top to bottom correction. This is a Fed that's loath to change the direction to the downside. So they're willing to risk cutting when they maybe shouldn't, just to keep the rally going.
Hi, Kathryn. This is Alessio. Do you think this is a one and done? This is the final adjustment to the calibration that they've been talking about? Or is it eventually one step towards a prolonged easing cycle?
Well, it should be a one more cut and done. That's what I think should happen. But I think, too, that this is a Fed that's wholly dependent not just on their dual mandate, which is, of course, both full employment and 2% inflation, which they've attained, but to a Fed that thinks itself has a more expansive mandate to extend the economic expansion, to bring credit to people that don't otherwise can get it. I mean, this is a Fed that has a more expansive mandate and considers itself, in my view, a Fed not just for the U.S. but for the globe. I mean, how many times have we heard in the Fed's communique and in the statements and in the minutes that the Fed is watching very closely global economic data points as well as trade. Trade really hasn't had an impact on economic data in the United States. It hasn't heretofore. So really the Fed doesn't have to cut an additional three times, which is what the Fed, Alessio, as you know, or what the market is currently pricing in.
And so from today's meeting, any particular words, any particular hint that you're focusing on, or do you think it's going to be a rather well-telegraphed meeting?
I suspect the Fed is going to sound slightly hawkish. They're going to go with some trepidation because we all know what happened when Powell speaks off the cuff. The last press conference, he almost completely read from a script. I suspect we're going to get something very similar. But the Fed is unlikely to sound exceedingly dovish, Alessio, because let's face it, the last couple inflation prints have come up to the upside. We haven't seen a continued deceleration in the inflation prints. That trend has been broken. Economic data, I would push back on some earlier comments. I think economic data is consistent with an economy that's not on the precipice of recession. This is a long-held view of mine. I think the market was overly discounting recession. It's not going to happen in the next year. So the Fed really should sound somewhat more hawkish. If it goes too far, however, even with one cut, I think the market will react to the downside.
So, Kathryn, I want to bring up what you said earlier, too, that you don't feel that the trade has any material impact on the economy. I mean, just in terms of inflation expectations, if you come inside the terminal, I mean, they're pretty much like nowhere. I mean, we're seeing the lows we've seen in years for the five-year break even. CFO confidence is super weak. We're probably going to get a read on sort of CapEx and investment in inventory at 8:30 with GDP. Why doesn't that all have to do with trade?
Well, certainly I'll agree with you that with regard to capital expenditures and capital planning, undoubtedly CEOs have stated that trade uncertainties have impaired their ability or their willingness to come out with additional CapEx or plans for the next 3 to 5 years. For sure, I agree with that. And in the last GDP print, we're going to get the 3Q today at 8:30, but in the last GDP print, we did see total investment for the first time in a while come out negative. I'm referring basically to inflation numbers. Look at total import prices year over year. They've actually been declining. We've seen real wages rising. That includes inflation. So really the purchasing power of the U.S. consumer has not been materially affected to the downside as was the forecast by many.
So we have an IB question, a terminal user coming in, and I'll put this to both of you. So let's do to you first. The conversation here is at this point the problem is a stock exchange level. Is the Fed just basically extending the stock exchange? It's just equities, and they're creating a bubble on the equity side. I mean, is that what this is? Like, the Fed's going to be looking at the S&P? Not really, but in theory, I mean, like, okay, well, they're telling us something we're going to have to defend.
Right. It's difficult at this stage to make, both in absolute terms and in relative terms, a case for imbalances in financial markets and a case for, at least in equities, and a case for expensive valuations. When you look at equities, not only in the US but globally, compared to global bond yields, the valuations are absolutely reasonable, if not even cheap. So it's really important as investors to look at it in relative terms. The outperformance that we're seeing in equities is just matching the decline in global bond yields and the rally in bonds that we have seen over the last 2 years. Just to quote some numbers, over the last 2 years, the performance of the ACWI benchmark, basically global equities, is exactly in line with global government bonds, which tells you that equities are not outperforming on total returns, or leave alone on a risk-adjusted basis. If we get a turn in the economic data, I think we actually have room, fundamentally justified, to extend this cycle higher.
So, Kathryn, wrap this into sort of what Alessio and I were talking about at the beginning of the show, which was the catalyst for driving money then out of the U.S. On a relative basis, if we still have more room to go, what's going to lead that money, though, to Europe, to emerging markets, to the global value trade?
It's really hard to see that. I mean, if we're getting a melt up in the United States, it's hard to really expect that money to flow to the emerging markets, which, with the exception of Asia, are largely decelerating in terms of economic growth, and in Latin America are in complete political upheaval. Europe, which has economic growth far inferior to the United States and a wholesale lack of any structural reforms, with a central bank that's in negative rates and likely to go even more negative. So if I were to choose, which of course I do on a daily basis, it's to pick within the United States. I like U.S. equities. I like them hedged, as I've mentioned on your program today. I think that you need to protect your upside. So you've had a pretty strong appreciation, but you need to protect that. And I like put options with March expiry just as a form of protection. It gets you through multiple Fed meetings. It gets you through Iowa and New Hampshire, and it gets you through Super Tuesday.
All right, let's say the longest of Invesco, Kathryn Rooney Vera of Bull Take. Both of you are sticking with me. Kathryn, what do you think?
I tend to agree with Alessio. I think that that he's right on multiple points. One of the things that I'm cautious about, and I think is important to highlight, Alex, is that a lot of this rally that we've seen has been led by the tech sector. So we have Apple and Facebook, if I'm not mistaken, both reporting today, and those two combined have been, what, 14%, account for 14% of the S&P's 21% rally year to date. I mean, these are names that, when a market momentum is led by one sector or three stocks, it's vulnerable to reversal. So that's the one thing I would highlight here. Let's see how tech earnings come out, because we can get, if they come out to the downside, like we saw with Alphabet, we can get a shift in sentiment and a shift in momentum on three stocks, let's say, that are, what, 10% of the market cap of the S&P: Alphabet, Apple, and Facebook.
And Kathryn, those are some of the risks that you highlight in the tech sector. Which other sectors do you tend to favor at this stage?
Well, I agree with you with regard to financials. If effectively, as we've seen the 10-year move from 1.4% to 1.8% and change, as we've seen in recent weeks, then of course that favors financials, specifically at the expense of counterparts, for example, in Europe. So if we are in a stage, as I think we are, of continued economic expansion, lower regulation or less regulation, and either a steepening yield curve or rising 10-year Treasury yields, then of course that favors financials. I would be careful with that, as I've mentioned previously, with regard to political risk. I think that could be a downside for the sector, but fundamentally I would say that that's one of the sectors that I like.
And now, Kathryn, that raises an interesting question, especially for us. We have just built a good narrative and a case for value in the U.S. When we think about Europe and emerging markets and how much, at the aggregate level, there is more of a value bias, obviously, particularly in Europe. Do we see then a bit of a disconnect in the way value will trade globally, given some more the fundamental challenges for value in Europe?
Well, that's a good question. And look, I think, for example, European banks, and I think we're going to talk about this soon enough, are fundamentally weak. And they're trading weak because they're fundamentally weak. I mean, we have an ECB that's now with deposit rates of negative 0.5%, right? And we have onerous regulation in Europe with the lack of any semblance of change in the near term. And I think that the ECB is going to continue to follow the same path as we've seen in the last meeting with Christine Lagarde as the new ECB president. So I think that you're going to continue to find more value in the counterpart U.S. than in Europe, for example. European banks will, however, at some point really jump once we get an ECB that looks like it might change course and might eventually lift the banks off of that negative deposit rate where they effectively have to pay the ECB to keep their money with the central bank.
A good conversation, guys. Alessio De Longus of Invesco and Kathryn Rooney Vera of Baltic. Both of you are sticking with me. So joining us from Washington is Michael McKee, Bloomberg International Economics and Policy Correspondent. Alessio De Longus of Invesco still with me on set, as well as Kathryn Rooney Vera of Baltic. Okay, so we have a lot to kind of tick through here, Mike. I want to start with the eco data coming in stronger than expected on the GDP front and the personal consumption front. Walk us through some of the details you've noticed.
Well, it's interesting, Alex, because it's a relative basis, relative to expectations, better than expected. But this is still very weak growth around potential, if you think potential is below 2%. And so that's a political problem for the folks at 1600 Pennsylvania Avenue. But when you look at the numbers, it pretty much breaks down, as we've seen over the last couple of quarters, where you have strong consumer spending and very weak business investment. Non-residential fixed investment down 3%. Second quarter in a row that we have seen business spending contract. We also see $69 billion in inventories. That's come off a little bit from the stocking up ahead of tariffs that we saw late last year and early in the first quarter. But we also see net exports, big subtraction from growth, almost a full percentage point, because trade is really hurting the economy at this point. So growth would have been significantly stronger if not for the trade wars, it appears, and for the uncertainty that business is facing over all that.
Yeah, to also just highlight on that, non-residential fixed investment. So basically, if you're spending on structure, fell a whopping 15.3%. That's the most since the fourth quarter of 2015. A large part of that, though, is oil and gas and cutbacks there in exploration. That's not going to be helped no matter how much the Fed winds up cutting. That's a broader structural issue. Kathryn, you've heard some of the numbers here. Does this make you more or less bullish, or is it in line?
Well, it came out surprising to the upside, right? And I would say that it's important for the audience and for Mike to remember that the consumption is 70% of the U.S. economy. So until we get trade wars impacting U.S. consumer, namely from both real wage side, from the unemployment side, or from the sentiment side, then it's really, I would say, a good number. I mean, we had 3% in 1Q, 2% in 2Q, and now 1.9%, which surprised to both consensus and my expectations. The consumer remains very strong, and I think that's important to remember. Both consumer confidence and small business confidence are at the highest levels that we've seen in more than 10 years. So I look at these numbers and I say, you know what, they're pretty good. Potential growth in the U.S. is 2.2%, so it's just marginally below for one quarter potential growth.
I agree with Kathryn. What we're seeing, this report confirms the narrative of everything we have known for the last few quarters, if not years, right? It's a dual-speed economy where domestic demand, the consumer is doing very well. The challenges to investments and the external sector remain there. But most importantly, it also delivers a lack of inflationary pressures, right? The inflationary numbers continue to be non-existent, which basically confirms the status quo of a policy environment that has reached an equilibrium. Growth continues to slow down, but not as bad as we feared. So we're focusing on the downside risks, and this report has not validated those fears for downside risks. Now, let's always keep in mind, GDP data, Q3, it's somewhat backward-looking. We already have more information about Q4, and it's important from a financial market standpoint to not look into the rearview mirror and keep looking on a go-forward basis.
Mike?
Yeah, I just want to note that the inflation data isn't all that good. It depends on how you look at it, of course. But when you look at the core PCE rate for the quarter, up 2.2%, it's starting to look like inflation is creeping into the economy. Nothing very big, nothing very fast. And the Fed's target is the headline number. But they are seeing a little bit of what they expected, that inflation pressures would build. And we're certainly seeing, with a shortage of workers and unemployment as low as it is, a little bit more wage pressure out there. And so they're going to look at this, and this could come into the discussion as they think about whether they want to signal another rate cut coming or they want to signal a pause and let's see what happens. Because if inflation is building, they don't want to be too far out on the curve, or too far behind the curve, rather. We'll get more data on that when we get the PCE numbers coming out tomorrow.
Kathryn?
Yeah, again, I'll take the other side of Mike, because I think that inflation is actually good. So what you don't want to see is you don't want to see sustained disinflationary pressure. So we ended last year 1.9%. We saw inflation continually tick lower and lower and lower. So that would incite a response by the Fed and by the government and everybody to deter us from going into deflation. So some amount of inflation, I think, is good, especially when our target is 2%. So look, core PCE on a monthly basis is coming out in a couple days, if I'm not mistaken. And I think with inflation ticking slightly up and an economy that's continuing to grow with record high equity markets, that seems like a pretty good scenario. And in a scenario, Alex, where the Fed shouldn't cut another 3 times, the Fed should cut one more time, max, and say, we did it, guys.
Great point to sort of button that up. I just want to also hit on this Treasury refunding announcement, because twofold happening here. One is that they're looking at what the Fed buying T-bills will do to affect their issuance. The theory is that if the the Fed's going to keep buying T-bills at lower yields, it makes actually borrowing at that level much more attractive. The other news that we learned is that they're looking at new products like a 20-year bond, potentially a 50-year bond. Mike, did anything stand out to you in terms of the refunding announcement today?
Well, they didn't make decisions, but those new issues could be important, Alex. The market's been looking at the fact that rates are so low and saying, why doesn't the U.S. go out on the curve like other countries have done? There's no appetite for a 100-year bond here, but the Treasury has been asking the Treasury Borrowing Advisory Committee, and there's been a lot of interest in a 20-year. The 50-year was something they'd floated. We don't know if there's a lot of interest on Wall Street. There hadn't been, but it may be that they're finding a little bit more of it. And, of course, they're trying to push SOFR, the replacement for LIBOR, so linking a bill to that would be something useful.
Kathryn, unfair question. Like, what would you do with a 20-year bond? Would you be like, great, a good way to hedge? Like, what would you care in the market?
If the U.S. issued a 20-year bond?
Yeah.
Yeah, I mean, I think I really wouldn't care that much. I think that yields are so low in the United States. If we're comparing U.S. versus Europe, yeah, a 1.5% or 2% bond looks much more attractive than what counterparts have. But you can certainly find yield elsewhere. And I think with the Fed continuing to drop rates and global monetary expansion, the markets and market participants like us and others are forced to do so. So that's where I'll bring it back to negative interest rate policy, because I think that is producing massive distortions at a global level, where you get people going out the duration curve, going out the risk curve, and taking on an inordinate amount of risk for his or her investment profile.
All right, guys, thanks a lot. I really appreciate it. Bloomberg's Michael McKee, thank you. Alessio DeLongis of Invesco, you will be sticking with me. Kathryn Rooney Vera of Bulltick, thank you very much. Always a pleasure to see you as well.